So the basics of multifamily / apartment syndication. So first off, I want to mention to you guys that from this point forward, I'm just going to use the words apartment syndication because multifamily and apartment are synonymous. The reason why multifamily is what we typically use in like the multifamily investor nation and various things like that is because it encompasses more than apartments. So it encompasses everything down to, 2, 3, 4, 5, 6 units, all the way up to, 1,000 plus, or whatever. So, but the apartment syndication is what we're going to cover primarily today. And the reason why you'll find out soon enough is because the apartment syndication, the syndication model typically is advantageous, is most advantageous when you get into the larger units, or even at least, I'd probably say at least around that, $1.5 to $2 million valuation mark. So you can do it, and you can do it less than that. But as far as being cost effective, it's definitely a book that you want to have in the beginning. So, all right. All right, let's go ahead and move on to the disclaimer that I'm going to have for you here. This is something that legal wants me to say. So I'm not an attorney. I'm not a financial advisor. I'm not an accountant. I don't play to be one on TV. And I didn't stay at a Holiday Inn Express last night. So I just want to let you guys know that up front, this webinar is to be used for informational purposes only. Please make sure that you seek legal advice, financial advice, and tax advice as well from the appropriate people that you need to. All right, moving on. Just a little bit about me. I'm Dan Handford. I'm the founder of the Multifamily Investor Nation. I'm also a key principal and partner with PassiveInvesting.com. And if you're interested in passively investing with some of our deals that we're putting together in our group, you can sign up at PassiveInvesting.com to do that. There's no charge to sign up as a passive investing partner, but when you sign up, we'll get on the phone with you, have a conversation with you to make sure that our goals and your goals align. And we do accept sophisticated investors as well as accredited investors, and we're going to cover what that means later on in the presentation today. So first off, I'm the owner of 5 specialty medical clinics here in South Carolina, and I have investments in $125 million worth of real estate and multifamily real estate, and our portfolio consists of a little over 1,300 doors. And like I said earlier, founder of Multifamily Investor Nation, and also the co-host with my wife. We do a podcast together called the Tough Decisions for Entrepreneurs podcast. And so you can check that out. We're also going to be launching the Multifamily Investor Nation podcast at the event tomorrow. So we're still waiting on our final approval from iTunes, but if you're watching this after the webinar, most likely it's been approved because usually it takes a couple of days. But what we do on the podcast there is interview in multifamily investors that have actually closed deals, and we get down to the nitty-gritty, no fluff of really how'd you find the deal, how was it working with the brokers, how was it working with the sellers, the lenders, the legal, the seller, I mean, everything from the time that they didn't get the deal until the time that they got it under LOI, the letter of intent, and the contract, all the way through until they closed it, and even some post-closing things as well. So it's very, very granular. It's a little bit of a longer podcast. So it's usually about 45 minutes to an hour. But the ones that we've done so far, the episodes are going to be phenomenal. I love them. I've even learned a lot myself at the same time. So let's also show you a little bit about my family. So I told you I have my wife, obviously. So I'm married with 4 children. You can see us there on the screen. And this one in the top right is my wife, Danae, and I. We're actually at a baseball game. And this one right here this bottom right is my 3rd child, Chloe. So she is looking and reading through the Jacksonville market analysis and market research pamphlet that I had in the backseat of my car at the time. So that's why I took a picture of her, because I figured she might eventually be my future multifamily investor. So she's a lot of fun. Of course, here in the middle is Caleb. He is 6 years old now. And then on the top left here is my wife again with our our fourth child. This is Callie, and she is turning 1 month in about a week. So she is going to be about a little bit over a week, so almost 1 year old. And then you can see here in this picture, Caroline, she's over here to my left in this picture, or our right, I guess. And she is my oldest, so she is 8 years old. So just want to give you kind of insight about that. Definitely doing this alongside of raising a family at the same time. So what is apartment syndication? Apartment syndication is so I'm going to define it for you. So apartment syndication is the pooling of money and pooling of numerous investors to get together to buy an apartment complex and have a business plan executed to be able to create some sort of forced depreciation in that property. And the reason why apartment syndication is so advantageous for an investor is that it allows you to share risks and return. And so there's lots of other nuances to why apartment syndication is good. And a couple of them is, number one is the tax advantages of it. When you're trying to talk about, investing in the stock market and, various mutual funds and REITs and stuff like that, you don't get to take advantage of a lot of the tax benefits that you get when you're investing in real estate. So our group only buys cash flowing assets. We don't buy unstabilized assets. We don't actually invest in new development because our investors want cash flow day one. The day we sign the documents to close, we're already making money. And that way, that's what we're looking for in our assets that we're acquiring. We actually acquire them primarily in the Southeast as well as in the Texas markets. And so the apartment syndication allows you to share risk and return. It also allows you to share the tax advantages of depreciation, because there's 3 different types of depreciation that apartments get. Number one is your standard depreciation, which you would get on any type of asset, and most of these you can get on just about any type of asset, but it doesn't make sense financially sometimes until you get into the larger aspects of the apartments that it makes sense to pay money to have somebody come in and do what's called cost segregation. And that leads us into the second one, which is the accelerated depreciation. So accelerated depreciation allows you to take your asset that you would normally depreciate over 27 and a half years. Because this is a residential facility, it is considered residential, so you can depreciate it over 27 and a half years. But when you do cost segregation, you can now accelerate some of the items and pieces and property within that asset to 5 to 15 years, depending on the item. So cost segregation allows you to hire an outside engineer firm and have them piecemeal the property down to the sheetrock and the studs and the appliances and the doorknobs and the light fixtures and everything, and accelerate that depreciation. So you have standard depreciation, which is basically depreciating the actual building, because you can't depreciate land. You're depreciating the building over a 27 and a half year schedule, but then also hiring a cost segregation team to come in and actually give you a study which shows that you can accelerate the depreciation. So now you have some of it that you can accelerate. And then the third piece is bonus depreciation. And this means this is where you're allowed to take some of the expenses that you're putting into the property when you're starting to renovate it in that first year, and expense 100% of some of those expenses. And so it's not all of the expenses, but a good majority of them you're able to expense when it comes to bonus depreciation. So those are the 3 things that, as far as a tax standpoint, are really good as far as depreciation, is that you can now make income, bring income off the property, but also show a loss at the end of the year. And depending on your qualifications and your tax status, you may be able to offset some of your other gains as well due to some of those losses. So you definitely want to check with your attorney or your tax attorney or your accountant to make sure you fit some of those qualifications. And so you typically, inside of these apartment syndications, you have what is called a syndicator, or also known as a sponsor or a general partner. So those are all kind of terms that are synonymous. General partner, a syndicator, and sponsor are all pretty much synonymous. The other piece of it is the investors. So those are your qualified investors, and we'll talk about what it means to be a qualified investor and what those different terms are. And that means you're a passive investor, right? And those are also known as limited partners. So the next piece here is, what's the difference between a passive investor and a active investor? And so the passive investor is somebody who is, again, like we mentioned earlier, is a limited partner in the syndication, if you will. And all they're there for is to provide equity or provide capital up front in exchange for equity in the deal to be able to allow the sponsor to acquire the asset. And so you are joining this LLC or this partnership as a limited partner that you are, because you are bringing money to the table. In most syndications, the minimum investment is $50,000, which is the case with our group. Some syndicators and some deals are more than that. That could be $100,000. I've seen them upwards to $1 million as a minimum investment. So it just depends on, you know, the investment and the number of people that they want to bring on, and the size of the deal, of course. And then, of course, you have your active investor. Your active investor is somebody who is actually trying to close deals, right? So they're the ones acquiring the asset. They're that sponsor or general partner in the deal. They are that syndicator. They're the active investor doing all of the legwork. So they're finding the deals. They're going through the due diligence. They're working with the lenders and the brokers and working with the property management company. And so they're doing a lot more of the legwork. And so they're, in exchange for their sweat equity, they get equity in the deal as well. And that's usually split between the passive investors and the active investor or the sponsor. So the general partner and the limited partners. So the next is the qualifications of a qualified investor. So the qualified investor is the accredited investor or non-accredited investor or sophisticated investor. And a qualified investor is deal specific. And what that means is that some syndicators will only allow accredited investors. So in order to be a qualified investor for their group, you have to be an accredited investor. If you are non-accredited, then most likely you are not qualified for that particular group. And there's also what is called a sophisticated investor. So a non-accredited investor is not the same thing as a sophisticated investor. Now, a sophisticated investor is a non-accredited investor, but just because you are non-accredited, it does not mean you are a sophisticated investor. So a sophisticated investor is somebody who has the knowledge and experience in financing and business matters and is capable of evaluating the merits and risks of the investment. And so in order for you, and that's a attestation, and what is called a 506B registration. And we'll talk about some of those 506B and C registrations with the SEC in a couple of slides once we get there. So again, accredited investor, let me define what that is. An accredited investor is a high net worth individual that has either a $1 million of net worth, or they have an annual income of $200,000 if they're single. Oh, I'm not moving my slides on the wrong thing here. I apologize for that. Let me move over here. I got two screens here, so I'm trying to work both of these at the same time. So this was the slide about the passive investor versus the accredited investor, or the active investor. And again, I do apologize for not advancing that. Thank you for putting that in the chat box. Let's see here. There you go. Accredited. This is when we're on right now. So the accredited investor is someone who has a net worth of $1 million or more, minimum net worth of $1 million, or they have $200,000 of annual income if they're single, $300,000 if you're married, and you expect that to continue. And I believe that the requirement is 2 years prior. You have to have at least 2 years of that income to be able to qualify for that. I may be wrong about the 2-year qualification, but I know for sure that the $200,000 and $300,000 and $1 million is the requirement to become an accredited investor. Now, we'll talk about what that means. So Michael is saying 2 years is correct. So you do have to have that for at least 2 years, and you have to also expect it to continue. So with that accredited status, there are certain deals that pretty much, if you're accredited, you are able to invest in just about all of these deals. And so some deals you are self-attesting that accreditation status, and some of these deals you also have to go through a third-party verification, and we will go through that when we get to that slide. So that's the difference between accredited and non-accredited. Non-accredited just basically means you don't meet those qualifications of a accredited investor. So if you don't meet those qualifications, then you are a non-accredited investor. And then you have to ask yourself, are you a sophisticated investor? And so the sophisticated investor is, again, somebody who has the knowledge and experience in financing and business matters that's capable of evaluating the merits and risks of the investment. And so most of the time, in most situations, because it is self-attestment, if you have, Gary did make a claim here on the chat box that says the $1 million net worth does not include your primary residence. So you cannot include your equity that you have in your primary residence in as far as your $1 million of net worth. So you have to have $1 million of net worth, not including your primary residence. So thank you, Gary, for putting that out there. That is true as well. So again, if you have any questions about the difference between accredited, non-accredited, and sophisticated, put them in the chat box and we'll discuss them. So those, I believe I've covered most of that as it is. So let's see here. No. So Brian is asking, is that liquid net worth? No. So liquidity is different than an actual net worth. So somebody could have a business that's valued at, say, $1 million, but they don't necessarily have $1 million liquid in their bank account or in the stock market. So the net worth does not have to be liquid. The liquidity doesn't come into play until we start talking about non-recourse debt, and we'll talk about that in a few slides here as well. So thank you, Brian, for asking that. Next slide here is going to be about the difference between a JV and a syndication. So JV is joint venture, so joint venture partnership. And the difference between a JV or a joint venture partnership and a syndication is that you have in a JV, you're not necessarily going through the SEC and meeting a lot of some of their requirements and filling out some of the PPMs and stuff like that. A JV is really reserved for a smaller number of investors, where you might only be you and maybe a couple other people that are getting in and pooling money together. But in order to not have to do the filings with the SEC and various things like that, you should, number one, before you get into any of this, consult an SEC attorney just to be safe and to make sure that you're completely legal. But the rule of thumb is that if all of you are putting your own money into the deal, or even if you're not putting money into the deal and you're one of the partners and you're exchanging equity for sweat equity, then but you have other money partners that are putting money into the deal, they have to play an active role in the investment. It can't just be passive for them. So when you're investing passively in a JV, technically, you're not supposed to do that. So legally, if you're passively investing and not doing anything in a partnership, then that would be considered something that you would have to go through the SEC with and go through the SEC syndication rules and regulations and stuff like that. So that's, again, one of the reasons why syndication only makes sense when you start to get into some of the little larger spaces, at least $1.5 to $2 million in valuation of the property, because there are costs involved of legal fees and filing fees and various things like that. It's not usually too terrible that it's going to break the bank or anything like that, but it's definitely something you need to consider when you are deciding between whether you do a JV, a joint venture, or a syndication. All right. So we already answered the next slide here. I put on here why syndication versus the JV. Well, a couple other things I'll note here is with a JV, with a syndication, you are sharing as a passive investor in a syndication, you have a lot more protections. And so in a joint venture, that you don't have protections like if somebody sues the property, something happens on the property, let's just say you don't have enough insurance, they're going to come after the people who own the property. But in a syndication, as a limited partner, you are protected from that. So you are because you are limited, you are protected from that barrier. Now, of course, in syndications, and I would hope in JVs you are always getting ample insurance as well as umbrella coverages and stuff like that. A lot of the lenders will require that anyway, but just from a liability standpoint, I would definitely make sure that you are fully covered from an insurance standpoint. And from a syndication standpoint, you're pretty much going to make sure, I mean, that's going to pretty much be taken care of. But in a JV, if you're getting involved with that, make sure that you have them show, declaration pages or, certificates of insurance to make sure that you're actually covered on that. And I would go even one step further and make sure that they have, that you actually have their name reserved for that too. So make sure that you are going through that proper process of verifying insurance just to continue to protect yourself. So that's another reason why syndications are safer than the JV. Plus, when you're doing a syndication, it's usually a larger deal, and so those larger deals usually hedge your risks a little bit more, have a lot more capital preservation involved, and various things like that. So what role does the SEC play when it comes to these SEC syndications? So the SEC is there, it's a government body that is there to protect you, right? The deal is there to protect you from the SEC is there to protect you from people who are maybe putting some deals together that really shouldn't be, and they're there to also investigate when things go south, right? So if you ever have a problem with a syndicator, then you can file a complaint with the SEC. If for some reason you're not getting the answers you're looking for, or you think or suspect something's going on with your deal, then you can alert the SEC. They'll come in and do a full investigation and audit financials and various things like that. And so it's rare when that happens, but it can happen, and it has happened, and it will continue to happen. So the SEC, there's two different types of registrations that most syndicators will use. There is what is called a Section 506C, B as in Bravo, and a 506 Section C as in Charlie. The 506B as in Bravo allows for up to 35 sophisticated investors into that deal, and then they can accept unlimited number of accredited investors. And so, but the biggest thing with the 506B2 is that the accredited investors are self-attesting, and the syndicator does not actually have to verify what they are self-attesting. So there are some other limitations with the 506B, meaning that you can't just put up a billboard and announce that you have this deal. Here are the returns. Come invest with me. You can advertise your investing company, so you can say what you do, but you can't actually advertise a specific deal. So if you have people that, if you see people on Facebook that are saying, hey, I have this deal, well, it either better be a 506C, which we'll talk about that in a minute, or they better already know you, right? But to just put a blanket billboard statement up on Facebook or social media or wherever and says, hey, I have this deal, it's in, I don't know, Timbuktu, Washington, and it's 147 units and 15% IRR, 8% cash on cash, 2.5x equity multiple. You can't do that unless you meet certain requirements like a 506B registration. And then there's other limitations which we'll cover there as well. And so on a 506B registration, again, you cannot advertise the deal, and you have to only accept 35 sophisticated investors, and you don't even have to accept sophisticated investors. So but the requirement is that you can only accept up to 35 sophisticated investors. And with those accredited investors and sophisticated investors, you also have to make sure that you have some form of pre-existing relationship with them. So you can't just meet somebody one day and just talk to them about a deal and then they're in it. You have to, if for some reason something happens with your deal or the SEC comes in and does an investigation, you have to show that you had some form of prior existing relationship with them in order for that to occur. So make sure you're doing that properly. And again, all of this stuff is available on the SEC website. It's nothing I'm coming up with. It's nothing new. You can definitely do that. And I would also encourage you, as you're getting into this space, to contact an SEC attorney to make sure that you do that. And at the MFI and Summit tomorrow, that starts tomorrow, I can't remember exactly when she's speaking, but we do have somebody speaking who is an SEC attorney. So make sure you tune into that session that she'll be on. The other thing with the SEC is the 506C. Okay, the 506C registration, you can advertise the specific deal. So if you want, you can put a billboard up, and you can put it up on social media and announce the deal. So as long as it's a 506C registration, then you can do that. The only other, well, not the only, but one of the limitations though is that you can only accept accredited investors. You cannot accept non-accredited or those sophisticated investors, which would be that piece of that type of non-accredited investor that you could possibly accept, or that you can accept in the 506B. So with the 506C, you can only accept accredited investors, and they have to go through some third-party verification, verifying bank statements and tax returns and various things like that to show that they actually are an accredited investor. So there are services out there that you can work with that will do that third party for the syndicator, but there is that extra step and level. So if you're the type of person where you're like, well, I only want to accept accredited investors, there's still two options for you. You can either go with a 506C and only accept accredited investors because that's the requirement, or you can go with the 506B and limit your deal, your project, to only accredited investors. Even though you have the ability to accept sophisticated, you do not have to accept the sophisticated investors. So hopefully that clears up a little bit of mud that you might have had about the different roles or different type of sections that the SEC has, and each one of these projects are not approved. When you do a deal, they're not considered approved by the SEC, but in most situations they are filed with the SEC so that they actually have the documents in place. That way, if they need to do an investigation and see who the operators are, they can do that. So let's shift gears here and talk about qualifications of a deal sponsor. So remember, we talked about the deal sponsor, right? The sponsor is that active investor or that syndicator who is putting the deal together, right? So they're the ones that need to be that don't need to be qualified, but there are some qualifications that are important when you're talk about these syndications. So that is one thing that's nice about the syndication space, is that you don't have to go to school to be a syndicator. You don't technically have to go learn under somebody else or do anything like that. You can just become a syndicator. And that's why so many people are able to come and become syndicators, is because there are not really any strict criteria that you have to follow to call yourself a syndicator and be a syndicator. But that also opens it up to making sure that you vet the syndicators that if you're deciding to do some passive investing, you want to make sure that you're vetting those deal sponsors to make sure that you're not investing with somebody that maybe doesn't know what they're doing. You want to make sure that they have enough business savvy and business sense to make proper business decisions, and maybe even have experience doing that. That would be definitely a preference of mine, to make sure that they actually had the ability to make decisions and they have experience doing that. And so there's not necessarily any qualifications per se, but what I like to see in a syndicator when I'm doing investing, because I'm an investor first. So the reason why I got into this is because I wanted to have deals and opportunities to invest. And so, yes, I'm putting my own deals together, and I invest alongside each one of my investors in our deals, and I also invest in other deals. So if you're a passive investor as well, I would make sure that the sponsor that you're dealing with, you ask them about their experience. You ask about what their business knowledge is, because when it comes to syndications, you're not really managing a property. You are in certain aspects, and I don't want to get blasted by saying, oh, yes, we are, but you're not there day to day managing tenants and the termites and the toilet paper and all this kind of stuff that popular other syndicators might tell you. As a syndicator, all you're managing is the management company who is managing the manager. So in most of these properties that are doing syndications that are at least 75, 100 units or more, there's going to be on-site property management, a property manager on-site, and there's going to probably be a maintenance person on-site, and then you're going to hire a property management company to manage those staff. And so you're going to be managing the management company who's going to be managing the manager. And so you want to make sure that the person who is putting the deal together, that deal sponsor, has the ability to do financial analyzing, because they're going to be looking at spreadsheets, hopefully on a weekly, if not daily basis, to make sure that the deal and the project and the business, if you will, is actually running smoothly. And so I know on our team, we have a gentleman by the name of Danny Randazzo. He's a financial analyst, and he's phenomenal. And at any moment, I can call him up and ask him, what is the current occupancy on one of our properties? And he knows it right off the top of his hand, and he just verified it that morning. So he's knowing on a very regular basis where his occupancy numbers are, so that if we start to see a dip or a change, we can pivot and make some changes, or call the property management company up and see what's going on, or worst case scenario, get rid of that property management company and put somebody else in place. And so there's definitely that piece and that component of it at the same time. All right, so when it comes to qualifications, obviously we're just talking about the deal sponsor themselves. Though when you start to talk about non-recourse debt, there's other qualifications that come into play. So when you start to talk about loan guarantors, there are 3 qualifications that are your key qualifications that you have to have in order to be a loan guarantor for any project. So you have to be able to have 3 things. Number 1, you have to have the net worth of the balance of the loan. So if you're buying a $10 million property and the balance on that property is going to be $7 million, then somebody on your team has to be on the loan as a loan guarantor that has a minimum net worth of $7 million. And they have to maintain that net worth throughout the hold of that asset. The second qualification is the liquidity. The liquidity conversation. So you have to have a minimum liquidity of most of the time. The minimum liquidity is 10% of the loan balance. Every lender is a little bit different, but Fannie Mae and Freddie Mac pretty much follow those guidelines. But some of your bridge non-recourse lenders follow a few little bit different guidelines. So you have to have a minimum net worth of the loan balance, minimum liquidity of at least 10% of the loan balance. And then number 3, you have to have experience, somebody on your team that has experience to manage these types of assets. Now, it doesn't necessarily, these 3 qualifications don't necessarily have to be all in one person. They can be added up through people in your team. So in that same scenario, let's say that there's, somebody else on your team that has $3 million net worth, and another one that has $1 million net worth, but then you only need to bring in another $3 or $4 million to meet that full $7 million net worth. So you can add up the people and then add up the net worth of the sponsors or the general partners in that group to make sure you meet those requirements. But I will tell you, lenders will give you better terms in most cases if you have a very high net worth that's more than the minimum balance, which is the minimum, which is the balance of the loan, which is the balance of the loan balance, if you will. The minimum balance is the minimum net worth is the minimum, or is the balance of the loan. So I know I just got my tongue tied a little bit there, but I think you get what I'm saying, that the loan guarantors can be added up, and you can get better terms in many situations if you have net worth that exceeds the loan balance. So if you have $7 million loan balance and you have $15 or $20 million of net worth in your team, then that will allow you to sometimes negotiate and get better terms with the various lenders. I'm going to take a drink here real quick because my throat's getting a little sore. All right. So hopefully, that is much better. All right. Let's see here. The loan guarantors. All right. Special considerations about non-recourse loans. Now, one of the biggest misconceptions about non-recourse loans is that the loan guarantor doesn't have anything on the line. They're just signing their name and that's it. Just using them as a balance sheet. And so why would I need to compensate somebody that I might have to bring onto my team if all they're doing is signing on a loan as non-recourse? Well, you have to ask yourself, why have a loan guarantor if it's non-recourse? Well, because they want to make sure that there's people on the team that can help the project if it starts to go south. But there are also what are called bad boy carve-outs in these non-recourse loans. And these non-recourse loans, if something happens to the property where you have, and they find that there is some sort of fraud or embezzlement or something like that happening on the property during that hold period, then they could come after you as well. And so I have a question coming here. It says, who are the guarantors in relation to the other people and what do they get? So a loan guarantor would be on the general partner side. So they have to be on the general partnership. So they would be a general partner and they would have to play an active role in the deal. So they have to be making decisions along with the team. So another term for a loan guarantor is also the key principal, because they're the one that allowed the deal to go forward to begin with. So they call them the key principal. So they are the key principal. They're the loan guarantors. At the end of the day, they are the ones responsible for making sure that that deal goes properly. And so most loan guarantors or key principals will only sign on with sponsors that they know can actually execute the plan, or they'll require more share of the GP equity in order to make sure that they're in the day-to-day decision making, so they can make sure that the deal goes properly. So a non-recourse loan is one of the reasons why apartment syndication is so nice, is that if for some reason you default on the loan, they do not come after you for the balance, right? They basically just take over the property, put it on the market, sell it, and then pay off your note. However, a non-recourse debt is one of those types of loans that, even though you have a loan guarantor, there are even if you are a loan guarantor, there are bad boy carve-outs, and then there are also lists that you could get put on where you can never get a loan again. Not never, but it might take a while for you to get another loan if you default on one of these loans. So I do know of somebody who had defaulted on one of these types of loans back in 2008, and now today, 10 years later, they have been able to be on some of those loans before. But it took a lot of time, many, many years to get back on to be able to sign these. So somebody who's a loan guarantor for these non-recourse loans, there are things at stake. So number one, you're using their balance sheet to be able to get the loan, but also there's those bad boy carve-outs, and there is also them being put on a list of not being able to get any of these types of loans in the future. And so many loan guarantors are very careful about who they actually sign on with. So the guarantor is the only one put on that list. So I'm not sure what list you're referring to, but I'm assuming you're probably talking about the loan guarantor list. But I'm not really sure. Michael, if you can clarify your question there about what list you're referring to, that'd be great. Oh, I know what you're talking about. The list that I was just talking about as far as if you default on the loan. So typically, the sponsor who is on the deal will be a loan guarantor along with the main key principal that's bringing the balance sheet. So let's just say, you bring me onto your team as a loan guarantor, key principal, and it's you and one other person, then all three of us would actually be signing on as the loan guarantor, but my balance sheet is what allowed the deal to get done for to be able to close that deal. So yes, everybody's name would get put onto that list. It's not just the loan guarantor. So anybody who was on that sponsor side would get on that piece. The limited partners, the passive investors, they're not going to get put on that list because they didn't have anything to do with it actually going south or defaulting. So that didn't have anything to do with that there. All right, great question there, Michael. And let's say I'm going to type these things out. I'm going to go ahead and open it up to questions, because I know I went through a lot of that stuff very quickly. So if you guys have any questions, I want you to go ahead and type them in here. So we have the Q&A box. I know some of you have typed them into the questions box, and so I'll go through those as I can and do that as well. So let's get through some of these. All right. Well, I guess if there's no questions coming in, all right, what's a non-recourse loan? So I think I answered that maybe, after you had mentioned that. So just to give a little bit more clarification about non-recourse. So a recourse loan is like a loan that you would get on your house. So most of the time you're signing a personal guarantee saying that if I default on this loan or on this mortgage, then you can come after my personal assets to be able to pay off whatever the difference is if for some reason I default. So and that's one of the risks of getting a personal residence is possibly not paying the mortgage, they come over and take over the property, but also come after your personal assets to make ends meet, if you will. And non-recourse debt, it does not, they do not come after your personal assets for that. A loan in which the lender cannot come after your personal asset that is default. Correct. Now they can come after your personal assets if there are bad boy, carve outs activated, if you will. And so if they find that there's some sort of, fraud or embezzlement or some sort of activity like that, then they can come after your personal assets. So there is some risks involved when it comes to non-recourse. It's not completely out. Let's see. Question here. Have you seen the lender approaching the KP for default scenario? In California, it is very hard for lenders to get to KP if they foreclose on the property. So a lender approaching the KP for the default scenario in California, it's very hard for lenders to get to KP if they foreclose on the property. So the lender approaching the KP or the loan guarantor. So I'm not sure about what they're talking about as far as approaching, but if it's a non-recourse debt, then even if they foreclose on it or they default, then and the bank takes the property back because it's non-recourse, then they wouldn't come after the KP. But if it's a recourse loan, then obviously every state's going to be a little bit different as far as what they can do in different scenarios. I don't know all those different nuances, but in most situations, if you have a recourse debt, they can come after you for that. So let's see here. The next question is Jindu. And Jindu Lee says, why would you choose accredited investors versus sophisticated? What are the benefits or cons of either? What has been your best experience? So good question, Jindu. So first thing I would say is if you have enough investors that are accredited that can help you, purchase the asset that you're looking at purchasing, then I would stay with accredited. In my opinion, accredited investors are the best investors to be able to help you, purchase an asset. That doesn't mean that I don't like that when sophisticated investors come on, because I do. And our group accepts sophisticated investors because we know some sophisticated investors are on their way to accredited status. But I will say that when you bring on sophisticated investors, it does raise more questions, and it does cause you to have to field more questions because they're usually sophisticated investors are a little bit more concerned about their money than the accredited investors. I'm not saying that accredited investors are not concerned, but usually the accredited investors have enough in their back pocket if for some reason something happens to that they're not going to completely go bankrupt. But sometimes your sophisticated investors are putting in, sometimes, $50,000 or $100,000 of $300,000 nest egg, and that's a third of their nest egg. And so there are some more considerations there. So in a perfect world, I would definitely say only accept accredited investors. But I also have a lot of people that follow me with Multifamily Investor Nation that are on their way to accredited status and still want to invest alongside us. And so we do allow them whenever we have a project that we put together through our passiveinvesting.com partnership there. So good question there, Jindu. Hopefully I answered that question. All right. C, can you talk about preferred returns, return of capital, and promotes? So we did a webinar along those same lines about preferred returns, return of capital, and promotes, but I will do another one specific to that, Bill. So thank you for bringing that up, but this is not the topic of this particular basics. Those are more advanced things, and we'll definitely do a webinar on that, so make sure you follow that. What are some standard fees and percentages that the GP will charge when executing a deal? I also, Stephen, did a webinar on that one. So a lot of these prior webinars you can find on our YouTube channel. So if you go to youtube.com, search for Multifamily Investor Nation, you'll find our channel there. And on there, you'll see our whole list of prior webinars where you can go through some of those. But I will also be doing some more of those on the fees as well. Can you give an example of the liquidity required for a $10 million deal? So obviously liquidity is going to be based on the loan balance. So for this example, if you have a $10 million asset that you're trying to acquire, but the loan balance is going to be $7 million because maybe you had a 75% LTV, so the bank is going to bring you excuse me, no, a 70 per, let's just say you have 75% LTV, right? So you have a $10 million deal, 7.5 million, I mean, 75% LTV, that loan to value ratio. So they're going to give you $7.5 million as a loan, but then of course there's additional fees that they'll add on top of that, and applications and legal and all that kind of stuff. So it's going to be a little bit more than that, but let's just say it's that $7.5 million loan balance. Then 10% of that $7.5 million is what you need to have. So you'd have to have at least $750,000 of liquidity in your partnership, in the general partnership between the loan guarantors and the other sponsors, in order for that deal to get closed with the specific lender. And the biggest thing with that is that liquidity must be maintained throughout the hold of that property. So they will usually do an annual audit or an annual attestation for you to show verification that you have that same liquidity as you're doing that. Somebody asked in here about Cardone Capital. I have not invested with Cardone Capital. I don't know if I would invest with them, but I'm kind of on the fence about Cardone Capital. I kind of feel like I want to throw a little bit money at some of his projects and deals, but I think right now with his structure that he's doing with funds versus deal specific, I'm not a big fan of. I prefer to vet deals individually and invest in deals myself individually as a passive investor, as well as when we're putting our own deals together. So that would be my caveat or my opinion on Cardone Capital. Do loan guarantors typically put any money into a deal to gain equity, or are they just putting up their value to gain equity on the deal? So it can go both ways, Nicole. So some lenders will require the loan guarantor to have some skin in the game. So they'll require them to put in some, like 5% of the total equity required. So in that same example, if you have if you're raising $2.5 million in a project and you have a loan guarantor that needs to bring in 5%, they're going to have to put in at least $125,000. And it cannot, and sometimes it can include like their fees to be a loan guarantor, because there's usually a loan guarantor percentage of the loan balance plus an equity position. And so sometimes some lenders will allow you to include that, but some lenders are pretty strict that they have to put their own cash in there over and above what their fees are. So you have to be careful from a lender standpoint and ask what those requirements are going to be up front. But in many situations, the loan guarantor is just bringing a balance sheet, and they're not bringing any equity into the deal as far as any money into the deal. But the deal wouldn't get done otherwise without them, and so that's where they have a little bit more leverage in being able to ask for some of those fees. Who is a good syndication attorney in San Diego I can connect with to get this process started? I don't have anybody in San Diego, but I know this weekend, I haven't used her, but Jillian Sadati with crowdfunding lawyers or crowdfunding attorneys, she is going to be at our Multifamily Investor Nation Summit in the next 3 days. She'll be one of the speakers, so you can check her out. There's also, I think her name is maybe Kim Taylor or something like that. There's a couple other, if you just Google syndication attorney and you will find one. And usually the syndication attorneys are not state specific, so they're usually on the federal level, so they can usually, because they're working with the SEC, so you can definitely reach out to a couple of those. But I don't have anybody specifically in San Diego that I know of, so I can't help you there. All right, next thing here is there an exchange available for GP and KPs that they could connect with each other and collaborate? So I am in the process. We tried something called Basecamp for our Multifamily Investor Nation Summit, but I'm putting together a forum specifically for multifamily investors, and it is going to be only available to people who purchased a ticket at the Multifamily Investor Nation Summit. And so we're going to be putting these summits on twice a year. And so this weekend is going to be starting tomorrow, Thursday, Friday, Saturday, is going to be the first one that we put on. And we'll have another one in June 2019. And then in January and June of every year following, we're going to continue to do these online summits. And so in order to get access to that forum, you will have to purchase a ticket to get it. So if you have purchased a ticket for the Multifamily Investor Nation Summit coming up tomorrow, that's January 17th, 18th, and 19th, 2019, you will get an email with access to that forum, and that's where you can be able to exchange and collaborate for available GP and KP. So good question there. Is the ultimate goal. All right. Considering the context of the webinar, of the questions, is the ultimate goal of the syndicator to get to the point that your total personal net worth exceeds the 3 criteria: balance of loan, liquidity, proven track record. At that point, you can GP yourself and focus primarily on LPs with your fee structure, promote management, preference, and positions. So you don't necessarily have to have those 3 qualifications to be a syndicator. So it's always nice because then you don't have to bring somebody else on your team that meets those requirements in order to get the loans. But so in order to get the loans, you do have to meet those 3 criteria. So if not you, but if you wanted to be the one on the loan, it allows the deal to get done. So you can be somebody who doesn't meet those criteria, but you are partnering with somebody else that does, and they can come alongside you. You run the deal, they're bringing their balance sheet, and it's a great win-win, and it's a great partnership. So that's definitely something that you can do. It's just not necessarily that you have to have those in order to be a syndicator. Are there prepayment penalties with agency lenders? Yes, every loan is a little bit different, but they usually have step down prepayment penalties. Usually they'll be it's like a 10-year loan. They'll do like a 5-5, 4-4, 3-3, 2-2, 1-1, where there'll be a 5-year prepayment penalty for the first 2 years, 4-year prepayment penalty, all that kind of. So it actually based on the lender on what they require as far as prepayment penalties. But there are prepayment penalties that you have to consider when you're exiting a property. All right. So hopefully that answered your question, Charles. Ben Jones, how much does setting up a syndication cost? I've heard figures in the $12,000 to $15,000 range. Yes, it's anywhere usually between about 10 on the low end, upwards to about 15. I've even seen it go up to about $20,000, and a lot of that depends on whether it's a 506B or C registration. The 506C registration, I think, might cost a little bit more. We just did a syndication and closed it in December, and it was roughly about $12,000 to $15,000, somewhere around there. I can't remember the exact figure, but it was definitely in that range, in that ballpark. So definitely make sure that you reach out to a couple of people and get some quotes to make sure that you're in there and you calculate it. But those fees, that fee range is why it really doesn't make sense until you get to above about $1.52 million to be able to afford to spend that kind of money and still make the deal work. So you have to bake that into the legal fees. When would you need to be a registered broker dealer? So when you're raising money, so we did a webinar on raising money. I'm not sure if we covered this, so I'll have to do another webinar about this. But the registered broker dealer is when you are helping raise money for a deal. And this, as far as apartment syndication, broker dealer stuff, if you're a broker dealer, then you can raise money for a deal and you don't have to be part of the general partnership. But if you are helping to raise money for the deal and you're not a broker dealer, then you have to be part of the general partnership in order to do that. So there's several different requirements and nuances to that. So I don't want to get into that because that's not what this particular webinar is for, but hopefully that was helpful. Well, guys, I'm sorry I can't answer all the rest of your questions. I really apologize. But I have a mastermind that I'm starting at 2 o'clock, so I need to jump off of here and jump onto that. Thank you guys so much. You have 1 hour from now. Get to mfinsummit.com. Sign up for the summit this weekend. Also get access to that special form that we're putting together for just the people who purchase tickets, and it won't open up. You can't get into that forum until the next event. And so the next event won't be until June. So make sure you grab your tickets. Expires in an hour. And thank you guys for attending. I appreciate it.